All right, everyone. Well, welcome in. We're excited to be here for the monthly markets and economy update. Tim and I have some really interesting topics to touch on today, including private credit, dispersion in asset classes, the further you go out, kind of on the private investment spectrum. So, looking at things like private equity, venture capital, other areas like that. So, before we dive into that, we will do our introductions, but I would like to start by really explaining how investment management gets nested into our overall process so that as we're talking about these things today, we're going to allude to other areas of planning and sort of how those fit together. So, at Destiny Capital, we developed our personal wealth operating system. For those of you who run businesses on EOS, it's going to feel very similar. Our job is really to be the integrator for you as the visionary in your life. If you don't run on EOS, what that really means is you decide what you want to do. You set the priorities, and we help to execute all of that. So there are four different pillars here. Get clear. So we always work with clients to understand vision and values, specific goals and needs, and how we're going to get to them. Grow wealth is where this investment management conversation originates from today. So that's growing capital, meeting needs for future rates of return, looking at tax management, risk management, all of those different components specific to investments. So we'll touch on a few of those today. Minimize risk. So that's looking at legal constructs. So your estate planning, your business ownership documents, insurance contracts, cash reserves, all of those different pieces fall under minimize risk. So definitely impacts these investment conversations as well. And then optimize equity. So if you own a business, what are you doing with that business equity ultimately? How are you managing it for the future? Is it an internal transition? Is it a long-term cash flow hold? Or are you building something to sell? All of those really interrelate together, and we're working to maximize life. So, really simply said, spending time with the people you want to spend time with, doing the things you want to do, and really creating the life for you and your family that you want to live. So, that's the personal wealth operating system. We're going to be hyper focused on the grow wealth and investment pillar of that today. So, I'm Jarrod Musick. I'm the CEO here at Destiny Capital. I sit on the investment committee along with Tim, and I'm really his thought partner. He drives all of our efforts on the investment front. Tim.
Yeah, thanks, Jarrod. Like Jarrod said, my name is Tim Doyle. I am the Chief Investment Officer here at Destiny Capital, where I lead our investment committee, where we do a number of things, which is including conducting capital market research, manager selection, fund due diligence, portfolio construction, trading, rebalancing, tools, tech, and more. And I work closely with our client service teams in executing the investment policy statements for our investors. And we also conduct this monthly webinar, and I write a monthly blog for markets and economy. And then I also have a CIO mailbag where guests can submit questions that I can either address in a webinar like this or directly to them. So yeah, like Jarrod said, we've got a lot of really interesting stuff to cover today. So I'm excited to get into it.
Awesome. Okay, well, media doesn't have much to talk about right now. There's nothing in the news as far as it comes to investments. No, seriously, we've had a lot of interesting topics that have been sort of top of mind for everybody. And then, it's the media's job to sell advertising, right? They want eyeballs, they want ears, they want attention, and these inflammatory kind of headlines are really good at grabbing our attention. So, Tim, what have we seen so far year to date, and what are we really monitoring as an investment team?
Yeah, lots of clickbait out there, and it's really not just focused on one particular asset class. It's kind of run the gamut, and that's one thing I've noticed to start the year. So you've got headlines, and we've got that written up at the top left of the page. Headline-driven hysteria. We've got hysteria in private credit markets. We've got meltdown in software stocks. Is that a warning sign for the rest of the stock market? We saw at least a day where gold and silver plunged in their worst day since 1980. And then we've seen another real risk on asset in Bitcoin selling off quite precipitously in the last few months. Just kind of adding to that chaos, that hysteria, and Bitcoin, as we all know, is a real clickbait, topic, asset class for investors. It's all over social media. It's all over the news networks because it does really garner a lot of attention. So What we're really going to focus on today is in private markets, that private credit piece of the headlines that we've seen play out over the last few weeks, because that's a really interesting asset class, one that we believe strongly in at Destiny Capital. And I think our message is that, not all private credit is created equally. And we'll kind of get into that, the why behind that, as we get further into this presentation. But, when we talk about private credit, there's a lot of strategies and sub-strategies that fall under that umbrella. And what we're going to focus on is by far the most popular element of private credit, and that's direct lending. So direct lending is where investors lend directly, hence the name, directly to middle market corporations. They're entirely bypassing traditional intermediaries like banks. So back after the great 2008, after the 2008 great financial crisis, there were a lot of regulatory rules put in place that really put the onus on banks and who they lent to, and put some rules and regs in there that prohibited them, or just at least made it harder for these banks to lend to middle market corporations. And that left a big void as far as lending is concerned. And what happened is in-stepped private markets, in-stepped private investors to fill that void for those middle market corporations, so they could get the lending they needed to grow, to service their clients, to grow their business, revenues, top line and bottom line. And that's really grown, private credit and direct lending specifically has grown precipitously in recent years, and over the past decade really has grown tremendously in popularity. So some characteristics about these loans are they are typically short-term, so on average 3 to 5 years in duration. They are floating rates and are often, more often than not, senior secured. That means that they are backed by borrower assets and sit atop the capital structure of that borrower in the event of a default. So that's an extra layer of security for investors because they are backed by assets or cash flows and so forth. So it's a very appealing asset class for a number of reasons, and we list some of those here. Private credit and direct lending offers really, really attractive income and a yield premium for investors. So some of these funds come with liquidity restrictions. So some funds might offer quarterly liquidity. Some might have multi-year lockups, but investors are compensated for that illiquidity in the form of that yield premium. There's complexity as well. These are complex loans. These are a little bit more complex investment structures, fund structures, and investors are compensated for that as well. And then there's credit risk. Obviously, any lending situation, there's going to be credit risk involved, and you put that all together, and what you generate is really strong yields. We're talking 9 to 10% yields on average over the long term for investors with very low volatility. So that's extremely attractive, particularly relative to liquid public markets, to standard bond markets. You're getting quite a premium over what you can get in liquid public markets. One thing that's also really appealing about this asset class is the fact that these are floating rate loans. So they move as interest rates move. I think we all know by now, or at least you probably learned based on what happened in 2022, is that there's an inverse relationship between bond prices and interest rates. So as interest rates move higher, bond prices fall. And if a loan, in this case, if debt is floating rate, it is not subject to those same issues. So what we saw in 2022 is we saw interest rates move higher, bond prices fall. That really didn't affect private credit or direct lending because these are floating rate instruments. So that's a real benefit. It kind of smooths the ride out over time. And for a portfolio constructor like myself, an investment manager, that's really, really appealing. It takes out a big element of interest rate risk and a big element of volatility there. So that's really appealing as well. There's diversification benefits. Of course, when constructing portfolios, diversification is crucial. Direct lending and private credit have low correlations to liquid public markets, both stocks and bonds. And like I said before, these loans have capital structure seniority. They sit atop the borrower's capital structure in the event of default. So that offers an additional level of protection and compensation in the event of a default for investors. But defaults tend to be very low in this asset class. So those are often mitigated and default risk isn't quite as high as the headlines would lead you to believe. So historically, what we've gotten with direct lending is equity-like returns, 9-10% returns over the long term with very, very, very low volatility. So really, why all the negative headlines? Well, I have a chart to the bottom right there that shows, the direct lending wall of worry. Headlines have been nothing new for private credit or for direct lending specifically. There's always something that is fluctuating or flowing through the headlines that news media outlets and social media will focus on, and that's just something that private credit has dealt with and overcome over time as returns continue to stack up year over year over year. And remember, traditional banks really want to get back into this middle market lending space, and with private credit taking up so much of the ownership in that area, that's really difficult for them to do. So they're trying to knock private credit down a little bit, a few pegs. So perhaps that leads to an opening for traditional banks to re-enter those markets as regulations subside and come down a little bit. So that's a little bit of a background on what direct lending and private credit is before we get into some of the issues that we've seen in the marketplace over the last few weeks. But before I do that, anything else you wanted to add to that, Jarrod? I know that was a lot.
No, I think it's a compelling asset class, and there's a reason why we've liked it over time and why we've gotten more comfortable with it. We feel like it's a value add for a lot of clients. Not every client, not every case, but really does add a lot of value there. So when we think about kind of where we started this conversation, which is headlines can be really negative. Media is there to sell advertising. Others who contribute to those stories, as you alluded to, may have an axe to grind.
Yeah.
And that's just kind of part of the media landscape that I think we all understand at this point. But there was one particular very visible fund, mainly based on the name that's attached to it,
Yep.
who did have some issues earlier this year. So do you want to kind of talk us through TCP Capital Corp and what we saw there and why that's prompted some additional questions and some additional conversation around private credit?
Yeah, it was really interesting. This garnered a lot of headlines just a few weeks ago. So at the end of January, uh, TCP Capital Corp, who utilizes BlackRock as their registered investment advisor, essentially. So their relationship with BlackRock really spurred headlines behind this because BlackRock's a huge name in the financial services business. So otherwise, TCP Capital Corp, that's not really a household name, right? But BlackRock is. So and this particular fund is a business development company. That's kind of a subset of direct lending. It's a fund structure, for lack of a better term. That's what a BDC or business development company is. And this company, this business development company, this fund reported Q4 2025 financials where they disclosed preliminary results in which they reported a 19% markdown in the fund's NAV. So essentially a nearly 20% decline in the fund's NAV that quarter. That's not the type of volatility, or that's not the type of move that you're expecting to see in a private credit fund. You're expecting to see, kind of steady Eddie NAVs over time. Of course, there's going to be fluctuations, but nothing to the tune of, double digits, to be sure. So that garnered a lot of headlines. So, and what was the reason for that markdown? Well, the fund had 6 particular underlying companies, and you can see this in the chart to the top right, where we've got the portfolio companies declining or driving the NAV decline. These 6 companies essentially defaulted. They were what we call in direct lending and private credit, they're non-accrual. So they're not paying back principal or interest on the loans that they took on. And obviously that's not what you want in a private lending fund. You want your companies to be paying back their loans, principal and interest on time, each and every time that those loans become due. And you could see who they were lending to in some of these cases. We're looking at Amazon, e-commerce aggregators. You're looking at home improvement companies and things like that. So then, when you see a markdown in something like this, and you see, headlines, this really does spur headlines in private credit from the national news media and on social media. And that started to spur on additional fears about private credit. So does private credit have too much exposure to the software sector, right? That's something we've seen in public markets, in stocks, for example, where we've seen companies like Microsoft selling off precipitously because is AI going to drive these companies out of business and so forth? So it was kind of a perfect storm for TCP, where they had the markdown and then the concerns about software, because TCP does have a lot of exposure. Their primary exposure is to the software sector. So then, it became, this self-fulfilling narrative about software, private credit, and defaults and concerns and so forth. So yes, there was some underlying truth to some of the headlines. Yes, there was some area of concern with this TCP fund. But from my perspective, really, it's like, this would be akin to, if you're exiting private credit because of a fund like this, that's a lot like selling out of the S&P 500 because one or two stocks sold off 30 to 40%, right? This is a huge, broad market with a ton of different and diverse strategies. And this is just one particular strategy that struggled. That doesn't mean that that's the case for the entire asset class. But it's also a cautionary tale. As the investor great Peter Lynch used to say, know what you own. And in the case of private credit, I think that's really, really important. That's really important to us at Destiny Capital, because there are some underlying issues that you need to be aware of in private credit when investing there. And some of that is concentration risk. That means that, all of your investment or most of your investment is tied up in a few underlying investments. So concentration risk in the chart to the bottom right helps to illustrate this. So what this chart to the bottom right shows is credit concentration among the top 25 largest lenders. Essentially the top 25 largest BDCs, business development companies, and or interval funds in the private credit space. And as you can see, on the bottom axis there, you see the number of holdings, the top holdings in those particular funds. And you've got top 5 holdings, top 7 holdings, top 10 holdings, top 15 holdings, and top 20 holdings. And as you see, for most of these funds, on average, the top 5 holdings comprise roughly 18.2% of the entire fund's NAV. Then as you move up to the top 20 holdings, you could have roughly half the fund in just 20 holdings, 20 individual companies. That's what I call concentration risk. When we're investing in private credit and direct lending, we like to see that more broadly diversified. So a fund that we invest in particular, as a comparison here at Destiny Capital, I'm not going to name the fund, but their top 5 credits are only about 5% of fund NAV. So very, very different from the profile that you're seeing on this page with the credit concentration across, these top 25 largest lenders. So that's something to be aware of, concentration risk, and also fund diversification. So not just diversification in number of underlying credits, so how many businesses they are lending to, but also diversification across underlying sectors, industries, and so forth. So in the case of TCP, again, like I said, they were heavily concentrated. Their largest exposures were in software. They also had, it was difficult to gauge some of their underlying holdings because 33% of the fund was classified as 33% of the fund's sector weighting was classified as other. So that to me lacks a little bit of transparency for investors. It's hard to understand exactly what you own when 33% or a third of the fund is described as other. So transparency can be an issue, but diversification is something you want to look at. Is the underlying allocation defensive? Is it aggressive? Is it growth oriented? Or is it well balanced? And we prefer a well balanced approach to our exposure in direct lending and private credit in general. And then there's also discipline. Is the investment manager for the private credit fund disciplined, or will they reach for yield? So as I said on the previous page, what these portfolio managers want to do for investors is generate yield, so generate income for investors, and you do that by increasing the yield from, if you can, if an investor is looking at a private credit fund and they see one has a 10% yield and the other has a 12% yield, they may say, well, that 12% yield's a little bit more attractive. I'm going to opt towards that one. Well, you have to think to yourself, how is that particular fund investing to get that extra 2%, that 2% spread over the other fund? In some cases, in the case of TCP here, it's likely they were stretching on credit risk in order to generate that yield. So they were taking on more risk. And maybe, and I know this was the case for TCP, we haven't even gotten into leverage yet, but they were leveraging their underlying portfolio to stretch that yield a little bit higher. And when you start to have defaults and you're heavily concentrated because you've taken on that credit risk, that can really cause a disastrous outcome like we saw with the 19% markdown in fund NAV and the subsequent sell-off there. So concentration risk you want to look at, diversification is crucial, and you want to look at who's managing the fund, what's their track record, are they disciplined, or do they tend to reach for yield to attract investor dollars? That can be great in good times, but in bad times that can really hit you negatively, and you have a negative outcome like we saw with this particular fund. So I know that was a lot again, Jarrod. Anything else, any other perspective you'd like to add to that?
No, I think it's an interesting example of how the headline tends to override the details. So this is a fund that's affiliated with BlackRock. BlackRock, for better or for worse, is a household name. It has a different investment approach. I'm not going to say a bad investment approach. It was just different, and the strategy ended up having a point here where it didn't perform very well, right? So when you get some of those elements where household name, large fund, really prominent, has a bad period, you're going to see more coverage of that. And I think that's just something to be cognizant of, whether we were, having this conversation today talking about private equity or venture capital or, different alternative assets, you're likely going to see that coverage skew accordingly. So maybe as we think about some of those other assets and why we're going to see different coverage that sort of paints that particular asset type or that asset class with a broad brush, can you kind of talk us through like what dispersion in returns means and why this is sort of normal and what we would expect from private
Yeah.
credit?
Yeah, exactly. This is nothing new for private markets where you have a fund that struggles. For every fund that struggles, there are likely one or many more who are knocking it out of the park. We kind of call that the dispersion in returns for private markets, where the difference between the top performers and the bottom performers is much wider in alternatives and in private markets than it is in liquid public markets. In stock investing, for example, when you're investing in a mutual fund, and this chart at the center of the page really helps to illustrate this. So to kind of walk you through this, I want to draw your attention to the narrow gray bar on the left side of this particular chart, where it shows the dispersion in return for large cap equities. So publicly traded stocks, large cap stocks, S&P 500 type companies. And these are essentially the investment managers and the dispersion in return between the top performing managers and the bottom performing managers in large cap, essentially in the large cap mutual fund space. So you have the top performers producing an annualized return over the last, basically since Q3 of 2015, an annualized return of almost 12%, so 11.7%. With the bottom performers at 9.4%, and the median coming in somewhere, but 10.5, 11%, let's call it. So, if you're investing with the top performer in this particular asset class, that's great. You're getting 11.7%. But also, if you miss on manager selection, and you happen to be with a bottom performer, you're roughly getting 9.5%. So that is a difference. You obviously want to be with the top, but it's not going to kill your portfolio if you're at 9% versus 11%. Yes, you want to be generating that alpha from that particular position, but I think that's most investors would say, well, okay, those are the breaks. I accept that. But then if you look to the far right of this page, and the large gray bar, we're looking at private equity. So private equity is a very, very different animal, where manager selection, and you see this the case for basically every alternative asset class, every private market across the universe. So we've got in this chart, we've got venture capital, hedge funds, private credit, non-core real estate, even core real estate. The dispersions are similar to liquid public markets, but still, that's something to be wary of as well. But focusing on private equity, I think it's really interesting that if you're with a top performing investment manager, fund manager, you're producing an annualized return of 20.4%. That's great, right? That's incredible. But what if you choose poorly? What if you're with a poor performing manager? You're down. You're barely in positive territory with a total return of 0.8%. That's not really where you want to be from your private equity investment, particularly given the risks that are involved with private equity. You've got illiquidity concerns. You're taking on additional risk. There's complexity. There's complex ownership structures. There's tax complexity for investors because there's often K2s. You want to be compensated for all that inconvenience. You want to be compensated for that risk. And if you're one of the bottom performers, you're just not getting what you're paying for. Even if you look at the median return, it's roughly equivalent to large cap U.S. equities. So why would you take on the illiquidity, all the risks that I just outlined and inconveniences to get the same return that you would get in the S&P 500 virtually, as far as median returns are concerned? So what I'm saying, I think what we're trying to get at is that in liquid public markets, manager selection isn't as crucial. When you're looking at private markets, when you're looking at alternatives, it's not enough to simply say you invest in private equity, say you invest in private credit. Hey, I've got an allocation of private credit and private equity and venture capital. I should be in great shape. It's who you invest with that's most important in these spaces. And that's what, at Destiny Capital, that's where we focus virtually all of our time when we're identifying and sourcing the best investment opportunities for our investors. We're looking for that top quartile in the private credit space, in private equity. And it's not an easy task, right? That is challenging. I would leave you with that, but I also want to stress that if you're interested in learning how we invest in private credit, for example, and in direct lending, reach out to our team. We feel very strongly about our allocations in private credit and direct lending, and in other areas of private credit where we have allocations and we have fund manager relationships. But I thought this is an interesting perspective, one that investors don't see very often, because their advisor or their team will just say, "Yep, we've got you invested in private credit. We've got you invested in private equity. You're all set," and you think you're in great shape until you see those bottom quartile returns, and those tend to be those outliers or those circumstances where the financial news media tend to glom onto those, and you'll see those in the headlines, like we saw with TCP Capital Corp over the last few weeks. So again, I know that was a lot. Jarrod, any perspective you wanted to add to that as well?
Yeah, I think this is just really good information as we move through our journey as investors. Usually when you start out, you're doing the basics, right? You have a 401k or 403b or some type of retirement plan at work. And you're either defaulted into an investment allocation, which is probably the right thing to do for first-time investors, or you have to pick something kind of out of the menu that's there, right? Usually we're not working with a financial planner and investment advisor at that point. You're doing the best you can. Well, most of those investments are over on the left side of the chart, right? You're investing in public market equities, you're investing in public market bonds, and the funds that are in there, whoever's providing that 401k or that 403b plan, what they're trying to do is give you a benefit and not get sued, right? So they're picking fairly vanilla investments in there where the plan participants should kind of stay in those gray bars, right? Hey, long term, we're going to get 10-ish% on our large US stocks, which is going to be a large chunk of the portfolio. Hey, our bonds are going to kind of be ballast. They'll return a couple of percent. That's what you get. Well, as you build wealth, as you found businesses, as you have liquidity events, as you receive inheritances, these other things that we see with investors, you end up with these different asset classes at least being a conversation, right? And if we don't think about them differently, you're setting yourself up to be disappointed potentially because there is such a varied degree of outcomes. And so going in with your eyes open and saying, okay, I am choosing to allocate to private equity or venture capital or private credit. But my process needs to be different, right? I'm not just picking the lowest expense ratio fund in my 401k for the S&P 500. What I'm actually looking for is what's the investment philosophy, what slice of that particular alternative market am I trying to get to, and how is that going to help with my overall total return and match with my goals? So, definitely the first two, large public market stuff, very vanilla. The further we go out, we're going to get dispersion of returns and your thinking should change. So I think that's my overall thought
Yeah.
that I kind of walk away from this conversation with.
Yep.
Um, Tim, as we look to close out here, what like takeaway or leaving thought would you want our viewers to stay with them?
Well, I think, when we're looking at specific asset classes, we're talking about private credit, we're talking about software stocks, we're talking about really small subsets of a bigger, broader financial picture, bigger, broader financial investment universe. And when you're a diversified investor, you can weather kind of these storms over time. When you see struggles in large caps or growth stocks, you've got your value stocks to come save the day a little bit and provide some of that ballast. You've got fixed income. So when you're reading these headlines, I think the point is don't get overly concerned. These are common. These are headlines that we see virtually all the time in financial markets. It can be a little bit concerning at times when you see that volatility coincide with those headlines, as they often do, and as we've seen to start the year. But when I look at our broad investments for our investors and their portfolio construction, I feel really strongly they're well suited, they're well allocated across a variety of non-correlated asset classes. And I see those particular allocations that are doing well, really contributing to returns on a year-to-date basis, and that's what they're supposed to be doing. That's why we construct portfolios very very diligently to help our investors weather volatility and that uncertainty over time, and that's exactly what we're here for and what we're doing. So I think I leave investors with that thought to close things out.
Yeah, that's a great point. Well, thank you. We're going to go ahead and end the conversation here, but as Tim said earlier, we do have our CIO mailbag. So head over to destinycapital.com. You can submit questions for future webinar topics. Submit questions directly to Tim, and we can get back to you. And if you already work with us, please reach out to your direct advisory team. Any questions that this conversation has prompted with you, let them know, and they can get back with you really, really quickly to help you understand what it means for you in your particular situation. So, thanks as always for giving us your valuable time. We do not take it lightly, and wish you all a great day. We'll be back again soon.